Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at our latest volatility means opportunity trade in the South Korea ETF EWY. Taking a look at a couple strangle comparatives from the last time EWY was trading here several months ago until now, and how the recent just huge jump in implied volatility based on the fear we've seen under the market provides some very nice trade opportunities with big time edge. So let's jump in and take a look, shall we? First of all, the EWY South Korean ETF, the two biggest holdings, Samsung, XKY, and Hynix. So two very solid companies. So you expect it to have a lower implied volatility given the weighting on these two is more than 40%. But we're seeing implied volatility absolutely go off the chart here, so to speak. So here's a 2 year or 5 year, actually, I pulled off implied volatility on a 360-day, basically slightly out of the money put at the money call. You can see had been kind of range bound here, chopping back and forth. Then we had this huge explosion over the past several days, right? All based on the Iranian conflict, right? The Straits of Hormuz, rumors that shipments will be dramatically affected. We shall see on that. But you can see implied volatility absolutely went ripping to by far the highest level over the past 5 years, which means option prices are at by far the highest level over the past 5 years. Pulled off a shorter term 3 month sort of chart here, and you can see again IV now hovering right around that 50 level. Not too long ago was only trading at 30, and we'll take a look back in this time frame here, right in late January when the ETF was trading basically at the same price versus now, and how that implied volatility affects the option pricing. Here you can see a longer term IV finally starting to maybe find some semblance of sanity after this big run up at by far the highest level over the past year. Here you can see from Thursday to Friday actually came in a little bit, right? And here is a kind of generalized look at the IV, which was hovering kind of in the upper 40s, low 50s. Then we saw this explosion. You can see it actually traded over 80, finally softening a little, but still very high at over 76. So set up for a couple very nice trade ideas. So I went back to January 29th, right? Or the 28th, actually. This is always a day lag. I'm taking a look at the look backs here, but took a look at the basically 50 point out of the money strangle right out in January of 2028. So selling the 75 put and the 175 call. So back then with the stock at 125 and change, right, that strangle was trading right around 15 bucks, as trading just around that 40 IV on the put side. Fast forward to Friday's close, you can see that same strangle right exploded, basically doubled in price from 15 bucks to almost 30. Why? Because we saw this huge jump in implied volatility from right around 40 to over 50. We can see with the stock even up a little bit, 126.73 versus our comparative date back in late January, 125.56. You can see the put prices, right, trading about $8 here. The patent here we're trading only at 450. So even with the stock up slightly and a decent amount of time passing, right, the puts jumped in price dramatically. The calls as well, simply because that sell strangle, as we said, went from 15 to 29. So another way to look at it too is you can get a bigger net credit or further out of the money, right? In our case, you can combine the two. So we'll take a look at a strangle that is further out of the money and at a bigger credit. So again, using that same benchmark date back January 28th, looking at that 175.75 sell strangle, again trading just over 15 bucks. Now we're taking a look at it versus selling the 60 put and the 190 call. So 15 points further out of the money on both sides. 15-point bigger cushion, yet that sell strangle actually trading almost 50% higher, right, at 23 bucks because of that huge jump in implied volatility. Note too, the 175 call back then, January 28th, right, with the stock at 125.56, right? That 175 call had a 34 delta. Take a look at Friday's close with the stock up a little bit, basically about a buck, right? A 15-point further out of the money call, trading at a higher delta. Why? Because we saw that huge jump in IV, right? From back then, right around that kind of mid 30 level till now, poking towards 50. And we can see that 60 190 sell strangle, right, at 23 bucks, right? Because the calls and puts both went up dramatically versus just over 15 back on our benchmark date in late January. And that was when the IV, as we said, was at a much lower level. And then we saw this huge run up on the fears coming out of the Straits of Hormuz. So taking a look at that comparative, January 28th, the stock at 125.56, the 175.75 sell strangle, 50 points out of the money, right? 722 days to expiration, IV at 33, trading at just over 15 bucks. Fast forward to Friday's close, the stock did go up slightly, right? $1.22, certainly not dramatically. Out of the money now, that 60 190 sell strangle, so 15 points further out of the money on each side, right? Which is over 10% more cushion, right? Given that the EWY is trading at 125-ish, right? And less time to expiration, 37 days, actually trading at a much higher price, right? Basically 50% more, simply because of this huge jump in implied volatility from just over 30 to just under 50. So it's a way you can get further out of the money, a bigger cushion, right? Basically, almost 20% further out of the money cushion on either side, get a bigger net credit, take advantage of that IV to put on the trade, and just looking at some point for this to calm down a little bit, right? And you can always move the strikes up and down, bring in more net premium to further hedge. Another way to look at it is an iron condor. So did the same sort of scenario here, but put on the protective wing. So going back to our benchmark date on January 29th, the 75 175 strangle, but bought the 180 and the 70 put for protection. You could have brought in $1.60 net, so you reduce your net cost by buying that protection, but you also define your risk, right? And you can kind of just say, you know what, I don't think it's going to go rip roaring up or down, but if it does, I'm still comfortable and I can live with $340 max risk on that. Fast forward to Friday's close, because that huge jump in IV, right? That 190.60 sell strangle, if you buy the 5-point further out protection again, you'd reduce the net credit, but you're still bringing in over $2.50, $2.85 versus just over $1.50 here. So here you're getting more than 100% potential risk return. Back here you're only getting about 33%. So certainly doing a iron condor trade, buying that protection makes sense as well. Define the risk, right? This one you only need a couple $100 or so to do the trade versus selling the naked. You give up a little bit by buying the protection, but you have that risk definition and a lower risk trade if something does go absolutely crazy. But this is a way to take advantage of what is a massive jump in implied volatility over the past week or so. Here you can see it on a longer term time frame, just how that IV has gone absolutely parabolic. So looking for that to pull back, looking for the EWY, right, which we, can kind of keep an eye on, finally looking, maybe find some support down here. Here's where, you're getting problems on that 175.75 put spread, so you got plenty of cushion on either side. Definitely getting oversold here with MACD at the lowest level of the past 12 months, right? Bollinger percent B heading towards zero, 9-day RSI pushing towards 30, right? And you can see here IV, which had absolutely hit a peak, right? The fear factor starting to soften, and usually spikes in IV are assigned to take advantage of it. So hopefully provides insight how we look at volatility equaling opportunity and how to structure trades in a sane way to take advantage of it on both sides, just looking to, in essence, take advantage of that implied volatility spike, having it revert back towards the mean, then we can take the trade off for a nice gain in a fairly neutral fashion at trade inception. So until next time, as always, here's to good trading. Take care.